This is Jody Trana with Chapter 4, Part 1 of Principles of Accounting. Here you can see we have an adjusted trial balance as of December 31, 2016. Let's take a look at the format of this report. We have a 3-line title that includes the company. It also includes the name of the report, and it includes a specific date, just like the balance sheet does. Remember that our income statement has a period identified, so it would be for the month of December or the month ending December 31, 2016. This is identifying specific balances as of this date, and that's why we just have the date here. The trial balance lists all of the accounts in that company, and it shows their balances with their debit balance and their credit balance appropriately. The trial balance should balance, and you'll notice here that our debit column does equal our credit column, and we have double underlined those balances. That's our accountant high five to say that yes, everything is good and we do balance our debits with our credits. The reason that we're balancing is because we've included every single account for this company. As long as we do our double entry accounting, our journal entries correctly with a debit and a credit, our company accounts will always stay in balance. This is an adjusted trial balance. That tells us that the adjusting journal entries have already been written and posted to each one of our ledger accounts. These balances are now ready to be used to create financial statements. Using the trial balance, we're going to work from the bottom of the statement to the top of the statement, preparing financial statements. The first statement that we always do is the income statement. The income statement includes the accounts, the revenue and expense accounts that are located on the bottom of our adjusted trial balance. We need to do our income statement first because we will need our net income or our net loss in order to complete the next report. The next report that we create is the Statement of Owner's Equity. Moving from the bottom to the top of the trial balance, we take the next two accounts, our capital accounts, and we're going to create a report. The reason that we do this report second is because the net income or loss that we calculated on our income statement is going to be part of this report. When we did the income statement first, the outcome was a number called net income or loss. That number was included on the Statement of Owner's Equity. The outcome of the Statement of Owner's Equity report is our equity balance or our capital balance. This number is needed to complete our balance sheet. Continuing to work our way up the trial balance, now we have the information that we need in order to create a balance sheet that balances. We started with the income statement and found our net income or loss. That net income or loss number was used in our Statement of Owner's Equity account to determine our total equity amount. And now we're going to take the assets and liabilities off of our trial balance and add this new equity number that we have off of our Statement of Owner's Equity to create our balance sheet that will indeed balance. Here we have the financial statements for Smart Touch Learning. This is the company that we have been using in class as an example. And if you'll remember, we opened this as a very new business based on a November 1 start date. So we've been in business for 2 months. Let's take a look at the format of the income statement. It starts with the title. The 3-line title includes the company name, the report name, and the date. Remember, on an income statement, we need to identify the period of time that is covered by the income statement. For Smart Touch Learning, we are doing an income statement for a 2-month period. That is November and December. So we say 2 months ended on December 31, 2016. You'll notice that we have revenue and expenses on this report. Revenues always comes first. We've included a subtitle of revenue. And if we had more than one revenue account, we would need a subtotal, under revenue that would add those two revenue numbers together. We also have a subtitle of expenses, and then we have listed all of our expenses in order of greatest expense to least expense. Because we have a number of expense accounts, we have also included a subtotal of total expenses to add them together. Net income is the difference between revenue and expenses, and when that is a positive number, it's called net income, and we do our double underline under that number when we have identified it. Now remember that this number is needed in order to complete the next report, called the Statement of Owner's Equity. Here we have our Statement of Owner's Equity for Smart Touch Learning. First, let's take a look at the format. We have our 3-line title with the company name, the report name, Statement of Owner's Equity, and the date. Notice that Statement of Owner's Equity is done the exact same way as the income statement, where it is created for a period of time. In this case, the same 2 months as our income statement. The purpose of the Statement of Owner's Equity is to uncover the total equity number that will be the capital account that shows on the balance sheet. To determine that number, we're going to take the original capital amount, which, since we have a startup company, that amount was 0. We're going to add in any owner contribution, and Bright put in $48,000 to start this company. We're also going to add in the net income for these 2 months covered in the Statement of Owner's Equity. That came from our income statement, and that is an addition to capital that increases our equity account. So we're adding that in. We are then going to have a subtotal amount. After that, owner's withdrawal. These are the amounts that we have taken out as the owner of the company, taken out of capital, so that reduces our equity. The difference between these calculations is $53,800. That is our total Bright capital amount that we're going to transfer onto our balance sheet. First, let's take a look at the Bright capital account, the $53,800 that we just determined off of our Statement of Owner's Equity report. That amount is shown here under our equity title on the balance sheet. Remember that the balance sheet must balance and that it also reflects our accounting equation. Here you can see we have assets on the left and we have liabilities and owner's equity on the right. That perfectly reflects our accounting equation of assets equals liabilities plus owner's equity. As far as the format goes, remember that we will always have our 3-line title. The balance sheet is different than the income statement and the Statement of Owner's Equity because it is a single date, single point in time. It's like our trial balance in that aspect. Under our assets, we're going to list all of our assets in order of liquidity. That's how quickly we could turn those assets into cash. On the liabilities side, we think of it somewhat the same way, but how quickly we're going to pay these amounts. So accounts payable, utilities payable, salaries payable, interest payable, these are all amounts that we pay pretty quickly. So you'll notice, other than accounts payable always being first, there isn't always a great order to put these in. Personally, I would have put salaries payable right under accounts payable because of the large amount that it had. You'll see here we also have unearned revenue and another liability, and then notes payable, which is a long-term liability. Here our liabilities and our equity are added together to get a total of $113,550, which equals our assets. Once we have an amount that agrees, we do our accountant high five and draw double lines under each amount. There are times when we will need to create the previously talked about statements in the format that they were shown. There's also times when we're going to be able to create financial statements just using our trial balance worksheet. I wanted to show that to you again now that we've talked about the more formal statements, and show you how we can do the same information here on our trial balance worksheet. So notice the first statement that we start with is section 5, the income statement. This is where we will add our revenue and add together all the expenses, finding the difference between the two to identify our net income. That net income number needs to be used in two places. It will be shown on our income statement in that column, section 5, in order to get those two columns to balance. We also need it in our section 6 balance sheet columns in order to get those two columns to balance. Where the income statement in section 5 uses our revenue and expense accounts, the balance sheet uses all of the other accounts, our assets, liabilities, and equity accounts. Still, it won't balance unless we include our net income. Most often in business, a classified balance sheet is used rather than the simple balance sheet format that we have been using. The classified balance sheet uses more subtitles to identify different sections of assets, different types and categories of assets and liabilities. Let's start by looking at the format. We'll start with the 3-line heading. The company comes first, and then the name of the report, and then the date. For the balance sheet, we have a single point in time rather than a period of time. Next, we will have the identification of the overall area, which is assets. So we will have a title called assets, and then we're going to have two subtitles. The first subtitle is for current assets, and then the second subtitle is for plant assets. There is a note here on the screen that identifies additional subcategories that could be in a balance sheet, but we're going to stick with just these for right now: current assets and plant assets. Notice every time we have a subtitle, we also have a subtotal. So for current assets, we have cash, accounts receivable, office supplies, prepaid rent, and then we have a total current assets subtotal. With plant assets, these are our more long-term assets. Here we have included our contra accounts. So furniture we have listed first because it is the most easily disposed of, less our accumulated depreciation furniture, with a net amount of $17,700. For each one of our plant assets, we want to identify the net amount right on our balance sheet. Notice that for land, there's no accumulated depreciation, as we do not depreciate land. All of these plant assets then are added together, all of their net values, the $17,700, the $59,750, and the $20,000 land are added together for our subtotal of total plant assets. Then these two amounts are added together for our total assets. Right now we would not double align this because we're not sure that it balances. We're going to go on to the next section of the balance sheet. Finally, let's take a look at the bottom of our balance sheet that includes the liabilities and owner's equity. Again, we have included a couple of subtotals in our liabilities section. We want to identify the current liabilities separately from the long-term liabilities. Current liabilities are those obligations that we will have paid within a year. Accounts payable, for example, is much sooner than a year, as well as utilities and salaries payable. So those are always listed first, as those will be paid probably within the next 30 days or less. We will always include a subtotal for our current liabilities, as well as a subtitle for long-term liabilities. Notice here that we only have one long-term liability, so we only need to have notes payable, our one account here. We don't have to have a subtotal. We'll add together our subtotal of current liabilities and our notes payable together to get total liabilities. Now in the owner's equity section, we only have one account, the Bright Capital account. Even though we have more than one account, we also have our withdrawals account. We have only included this one because this number, this $51,550, will come off of our statement of owner's equity. That statement will show more of the breakout. It will show the additional contributions from Bright. It will show the amount that Bright took out of the company, and it'll also show the net income. Some balance sheets will show all of those amounts right in the owner's equity. This one does not.